classic all-star charts fashion, I have about 100 slides to get through in 30 minutes. So we're going to keep this, I'll just get right into it. For those of you who don't know me, my name is Tom Bruni. I'm a technical analyst at All-Star Charts. I work with JC Peretz, Steve Straza, Sean is our options strategist. So together as a team, we're a technical analysis research platform. We help provide research, market commentary for financial advisors, wealth managers, individual investors, any market participant really. So without further ado, let's get into it. Listen, we're all adults here. This is not investment advice. This is for informational purposes only. allstarcharts.com/terms. We lay it all out there. If you have any questions, I'm going to be going through this quickly. So if you have any questions, save them till the end or find me afterward. If you miss any of the slides, info at allstarcharts.com. Email the subject line charts, and we'll get you the slide deck and answer any questions you might have. Alrighty, so the all-star charts approach. I want to take 5 minutes discussing how we approach markets so that you understand the research that I'm going to share. First off, we're a technical analysis only shop. We are not looking at fundamentals. We do not look at macroeconomic data. We're studying price, market behavior. That's it. We take a top-down approach. So we start at the index level, starting with all asset classes, break it down into each of the major indices all around the world, US, international, get down to the sectors and sub-industry groups, identify areas of relative strength, relative weakness, and then finally we get down to the individual stock level. So we're looking at thousands of charts every week, 5,000, 10,000 across multiple time frames. We're weighing the evidence. We don't take any shortcuts. We're looking at all of these charts ourselves, and we're putting together a picture for our clients, identifying the best themes, and coming up with the best ways to express those themes in the market. So in terms of our charts, we're not indicator junkies. We're not, you won't see a ton of stuff up here. We keep them super clean. We have price. We have a logarithmic scale. We're looking at daily, weekly, monthly time frames. We have a 200-period moving average, which we use to identify, help identify the trend. And then we have a momentum indicator, the relative strength index on the bottom to help with momentum. That's it. We keep it, we're a keep it simple, stupid shop, and that's what we stick to. Speaking of moving averages, we are not in the camp that moving averages provide support and resistance. Simply an invisible line helps us to identify what happened over the last 200 periods or whatever period you're measuring. And much like the market environment over the last 21 months or so, range-bound, choppy, volatile, flat 200-period moving averages signal a lack of trend within a market, and we want to avoid those because, as it says, we get headaches from those. Measuring momentum, there's a lot of different ways to do it. Relative strength index, MACD, slow stochastic, rate of change, pick your poison. Point is, you don't need all of them. They're all measuring the same thing, just in a slightly different way. We use the relative strength index. The way we use it primarily is by looking for bullish and bearish ranges. What does that mean? A good example is gold, 2009 to 2011, strong uptrend in price. Every time prices are making a new high, you see momentum getting overbought, confirming that buyers are in control, showing that they're aggressive. On the downside, when prices are correcting, pulling back toward that moving average, getting back into the long-term trend, momentum is not getting oversold, signaling that sellers are not able to take control during that corrective period. On the downside, opposite end of the spectrum, JP Morgan, 2007, clear downtrend. Each time prices make a new low, you see momentum getting oversold. When prices are correcting to the upside, you don't see any overbought conditions. In most cases, the weakest stocks will not even get above 60 or 50, which is the mid-range, but as long as it's not above 70, that's signaling that sellers remain in control. The other way we use relative strength, the relative strength index, is to identify potential reversal signals. So, gold miners, 2015, 2016, we have prices in a clear downtrend, making lower lows, and yet momentum puts in a bullish momentum divergence. It's making a higher low, signaling that sellers are becoming less aggressive, and we see a subsequent price reversal. Several months later, we see the opposite. Prices are making new highs, yet momentum is making lower highs, and again, we saw the trend reversal from there, so momentum was able to give us a quick heads up. Last concept I want to discuss is relative strength. So this is different than the relative strength index we just discussed. This is measuring the performance of one security relative to another. 2007, 2008, 2006, financials relative to the S&P 500, making lower highs. They're underperforming as the broader market is making new all-time highs. This was giving us a heads up that something was wrong in financials. We all know what happened in 2008, 2009. Market crashed, led lower by financials. Opposite end of the spectrum, we have Whole Foods during the tech bubble, late 90s. Tech stocks are going crazy. Whole Foods did absolutely nothing, showing relative weakness. But when the tech bubble burst and the NASDAQ composite was crashing, we saw Whole Foods breaking out, making new highs, outperforming. Those are the types of stocks we want to own. So those are the primary tools we use. We use other measures like sentiment, seasonality, other supplements to price. Not going to get into all of those today, but if you want to learn more about that, you can go to allstarcharts.com/education. We lay it all out. We're an open book. Speaking about the current market environment, let's set the framework for our discussion. S&P Global 100 is kind of a broad measure of what's happening around the world. As you can see, over the last 21, 22 months since January 2018, we've gone absolutely nowhere. Prices consolidating sideways. Now we're starting to see prices break out. This is a daily time frame, starting to see prices make new highs. This was just this week. Dow Jones Industrial Average looks very similar, right? If you take the 261.8% Fibonacci extension of the financial crisis decline, gets you to about 27,000. 27,000, that's exactly where we stopped in January 2018. We've been consolidating since, and it's our view that this is a cyclical bear market within a secular bull market, so it's our view that we will resolve to the upside, and we think that we are seeing that just now. For those of you thinking that's a Dow Jones Industrial Average, that's 30 stocks. All right, cool. Let's look at the Russell 3000. 98% of all investable assets in the US looks exactly the same, just a different price level. Same thing internationally, MSCI All Country World Index. Again, absolutely nothing for the last 21 months, frustrating buyers and sellers. Now we're finally seeing prices potentially resolving to the upside. This is a chart from my buddy Steve. He wasn't able to make it, but if you enjoy this presentation, make sure you find him on Twitter. Give him a shout out and thank him for adding value to the presentation. He gets just as much credit for this as I do, but if you hate it, just find me afterward. Don't give him any hate. It's fine. This is his custom index. He's looking at the 4 largest stocks in the market. Has a catchy name, MAGA. But again, 13% of the index. It's done absolutely nothing. Are you sensing a theme here? All of these charts look exactly the same. They've done nothing for 21, 22 months and are now attempting to resolve to the upside. Alrighty, before we get into a sector breakdown of US equities, I think it's important to look at the alternatives. At the end of the day, money's going to flow to where it's treated best. It doesn't matter what asset class it is. So let's look at interest rates. We don't have a lot of time, so I'll simply look at the 10-year Treasury yield. 6-7 years, it's been range bound between 3% and 1.25, 1.4 on the downside. Late last year, we saw stocks attempt to break out. We saw the 10-year try to get above 3%. Prices quickly failed there. Bonds had a massive rally. Rates around the world collapsed, and now we're back at the lower end of the range. Not an area we want to be aggressively short bonds. We'd much rather be looking for rates to stabilize, and that's kind of what we're seeing now. Like I said, globally, interest rates around the world were falling. Now we're starting to see a higher low form. Again, not saying the structural picture for interest rates is fixed, but we're starting to see signs of improvement, which is a positive for equities. Looking at credit spreads, if we were seeing stress in the credit markets, you would see it in the bond market. Cool, got a 10-minute warning. That means I am on track. I got 20 minutes left. Awesome. I practiced this presentation like 10 times in my hotel room, so if it goes as well as it did there, I will be super happy. So you guys can let me know whether or not that's happening. Just give me some signals with your eyes. If I see some people walk out, I know speed it up. But anyway, credit spreads. We're not seeing a ton of stress in the credit markets. We had that widening that happened at the end of the fourth quarter last year, but they've been narrowing since. They're flat. Again, if we're seeing stress in the credit markets or risk assets in general, we'd see it in bonds. We're not seeing that just yet. In terms of the inflation story, we have tips relative to their treasury counterparts of a similar duration. So if the bond market is expecting inflation to pick up, you're going to see treasury inflation-protected securities outperforming. This is not what this chart is showing. They're falling relative to treasuries. And as a result, inflation expectations over the last 18 months have collapsed. Now we're starting to see a bullish momentum divergence form. Downside momentum is waning. Potentially, we're starting to see a reversal. Maybe a reflation trade is just around the corner. Speaking of commodities, I don't know about you, but commodities have been an absolute mess for, 10 years. They've done absolutely nothing but go down. What a disaster. But prices are now back to 375 on the equally weighted commodity index. This is a major level of support. We have momentum diverging positively. This signals to us that we could be near the sign. We could be seeing signs of a bottom. We also have prices peaking above the downtrend line from the 2011 highs, also positive. Canadian dollar looks very similar. At the end of the day, Canadian dollar is very levered to the Canadian dollar and the Canadian economy are very levered to how commodities do. And it's no surprise that these charts look very similar. So if you see the Canadian dollar breaking out, you see commodities breaking out. Again, that's kind of along the same theme that we may be seeing some sort of reflation trade pick up. One area of commodities that has not sucked over the last year has been precious metals. So here we have an equally weighted precious metals chart relative to the rest of the commodity space. Clear uptrend, goes through long periods of consolidation, breaks out. Late last year we got a breakout. Precious metals have been the place to be. Listen, on an absolute basis, I've had tons of arguments with people, discussions with people about where gold is headed tomorrow, next week, next month. Cool, we can argue about that all day, but structurally, when we look at the long-term trend, this looks like a bottom to me. Prices did absolutely nothing for 6-7 years, finally broke out above 1350, 1375 resistance. As long as we're above that level, we gotta be buying weakness. I think that trend is clearly higher. We gotta be erring on the long side of gold. Same thing with silver. If we're above 14, gotta be long silver. Even platinum, this thing has been an absolute disaster, worst of the space, but this looks like a major bottom to me. Let me see if I can get this laser to work. Awesome. This has been a major disaster, but even this looks like a bottom. This is a smiley face, not a frowny face. We want to buy smiley faces. If we're above 880, if you want to be even more conservative, if we're above 760, the recent lows, I think you got to be erring on the long side. Palladium, if you follow me on Twitter, oh my God, I love palladium. This is my favorite chart in the world. Since 2016, monster trend, not only in precious metals, but in global markets in general. One of the best trends out there. Listen, this continues to work as long as we're above the early 2019 highs. I think you gotta be buying weakness in palladium. To be honest, I don't even know what palladium is. Yeah. I'm a technician. So I can't tell you that, but what I can tell you is there are more buyers than sellers at current levels, and we want to be long. All right, last thing I want to just touch on commodities is copper. This is super important for emerging markets. A lot of people talk about Dr. Copper and US equities. Not really what I'm doing here. The highest correlation is to emerging markets. We see a potential topping pattern here in copper, but prices failed to hold those lower, prices failed to hold those lower levels. We're now back above support. Commercial hedgers have one of their largest net long positions in history. They're probably not super long copper if they think prices are going lower. So I think as long as we're above the recent lows of 250, the squeeze is on in copper. Much like the Canadian dollar, the Australian dollar, very correlated to copper and base metals. That's why the chart looks very similar. If we're above 0.69 in this pair, I think the squeeze is on, and ultimately it heads higher. How am I doing on time? I got 15 minutes left, right?
You got a good 7-8 minutes.
7-8 minutes? Oof. This is bad. Are you sure?
Another 10.
All right, cool. 10 minutes. All right, so I'll run through this real quick.
Speed round. 30 minutes.
It's 15 minutes? All right, whatever. Utilities. Trending higher on an absolute basis, have been a great trade. US REITs, again, meeting our upside price objective. The point of these charts, real estate making new all-time highs. This is great in mid-cap land. Staples approaching new all-time highs. The reason I'm sharing these charts is because people will say, all right, utilities going up, that's bad, right? You want to see cyclical sectors leading, not utilities. Well, that's true on a relative basis, but on an absolute basis, as long as prices are trending higher in utilities and defensive sectors, that's consistent with higher prices in the S&P 500. So we're not super concerned. Equally weighted discretionary, we're taking Amazon out of the equation completely. New all-time highs, just about. This is not a bearish chart. We'll skip this. We'll skip industrials. I don't know, would these be pressing up against all-time highs if the world was ending? We think not. We think this breaks out and cyclicals start to lead and the market ultimately resolves higher. Mid-caps, again, pressing up against all-time highs. Aerospace and defense, despite all of the troubles that Boeing is having, getting new all-time highs, pressing up against them. The growth versus value story, really at the end of the day, what it comes down to is technology versus financials. If you look at this chart here, you can see that the growth sector, growth factor has 18% more technology than the value index. Value has 15% more financials. And so at the end of the day, if you think the growth value trend is turning, you need to believe that financials are going to outperform going forward and that technology is going to underperform. We're not in that camp yet. We think it's interesting in the near term, but not there yet. Financials, here we go. If they're going to outperform, they got to be above the 2007 highs. We're not there yet. We think we ultimately get a retest soon and ultimately a breakout, but we'll take it one step at a time. Financials relative to the S&P 500. This looks like a smiley face to me, not a frowny face. Want to be buying this. Financials improving on a relative basis. We're going to skip some of these, skip some of these, skip this. JP Morgan Chase, one of the biggest banks in the world, breaking out to new all-time highs. Hard to be super bearish when that's happening. Technology, despite the carnage in some of the software stocks, we're still hanging out near all-time highs. Technology relative to the S&P 500, yeah, put in a bit of a failed breakout in the near term. We could see some weakness, but structurally this trend is much higher. Software, testing support once again. Will it resolve lower with some of the other subsectors of technology that we've seen over the past couple months? Maybe. It's definitely vulnerable if it's below 205. But if you take a step back and look at the structural trend, even if software corrected 20% from current levels, it would still be in an uptrend. So I think it's important to have some perspective on where these stocks have come from. Same thing with Apple, sitting near all-time highs. Hard to be super bearish with that happening. Giancarlo, how am I doing on time? 5 minutes?
No, solid 10.
Oh, I have 10 minutes left?
10 full minutes.
Why am I skipping all these charts then? Come on. I got great charts. All right, I can slow down. Semiconductors. Semiconductors. New all-time highs just this week. It's very hard to be bearish the broader market when semiconductors are making new all-time highs. As you can see, the correlation between the semiconductor index and the global 100, positively correlated. So if we're seeing semis make new highs, that is potentially a leading indicator for stocks in general to move higher. All right, trip around the globe. I just got back from India last week, went for vacation. If you haven't been, it's awesome. Highly recommend it. But that's what inspired this part of the slide deck. Before I get into it, we're going to look at a lot of obscure countries, and I know what you guys are thinking. Tom, Bruni, what are you doing? I trade US stocks. I'm a day trader. What do I need this for? What do I need to care about Budapest for, or Taiwan, or any of these other countries for? Well, correlations have gone up over time. If equities in the US are doing well, equities around the globe are probably doing pretty well. If equities around the globe are doing poorly, equities in the US are probably struggling. So we need to know what's happening in the world so that we can identify the broader trend for equities as an asset class, as opposed to just focusing on the individual stock that we're trading. So we're going to fly through these, simply looking uptrend, downtrend, no trend. The AEX General Index pricing up against all-time highs, not too bearish. Budapest met our upside price objective, pulled back a bit, now pressing up against all-time highs again. Brazil, new all-time highs. The France CAC 40 index hitting its highest level since 2008. German DAX putting in a higher low on a structural basis, pressing up against 52-week highs. Again, not super bearish. FTSE 100, yeah, it stalled out a bit, but we're still above former resistance at around 7,000. If we're above that level, I think the bias is higher. Hard to be bearish that. OMX Copenhagen, new all-time highs. Russia, the MICEX index, new all-time highs. The Nikkei 225, this is a super long-term chart, lasts 30 years. I don't know about you, I see a bunch of smiley faces, not frowny faces. This looks like it's headed higher to me. New Zealand has been an absolute monster. I don't know if you guys have seen it, even the ETF, ENZL, massive performer. Yeah, it's taken a pause, but look where it's come from. Sitting near all-time highs. OMX Stockholm 30 index just this week, new all-time highs. OMX Helsinki All Share Index, 5 minutes left, all-time highs. Swiss Market Index, pennies from all-time highs. I don't know if you guys are sensing a theme here. TSX Composite Index, our buddies up in Canada, new all-time highs. The Australian 200, ASX 200, new all-time highs or consolidating below all-time highs. Taiwan with semiconductor exposure, new all-time highs, looks great. India, consolidating gains. Again, this looks like an uptrend to me, sitting just off all-time highs. And then finally, we have the broad look at Europe, stocks Europe 600. The more times the level is tested, the more likely it is to break. We've been testing this 405, 410 level for years now, for decades, trying to absorb that overhead supply. We think it's difficult for the end of the equity bull market run to be over without seeing a breakout in this first. So that's what we're looking for. And the trip around the globe definitely is a bit compelling in terms of equities as an asset class. All right, most important, risk management. Last few minutes, how do we know we're wrong? Well, if a lot of the things that I was just discussing start to roll over and change, that's a clear indication. What else? Stocks versus bonds. Again, looking at alternatives to equities. So we have bonds outperforming this year. If we see this ratio start to roll over and stocks are making new lows relative to bonds, that's a problem. Same thing, stocks versus gold. If we see this ratio rolling over and stocks are underperforming gold, guess what? Money's going to flow into gold and out of equities. Microcaps versus megacaps. If people are scared, if their risk appetite is low, they're going to sit and wait it out in defensive sectors and mega cap companies, not in these little micro cap companies that nobody's ever heard of. So we're seeing a potential bullish divergence here in micro caps relative to mega caps. If prices can hold these lows and move higher, that would be bullish for risk appetite. On the other hand, if we're rolling over, probably not in an environment where stocks are doing too well. Russell 2000, Dow Transports, two of the major laggards over the last 8 months or so. They look exactly the same. If these things are rolling over instead of resolving higher, that's an issue. Probably not something we want to be long, but for now, they look fine. I think I got 2-3 more slides left. We'll run through these. Come on, clicker. There we go. Technology, if this near-term underperformance expands, that could be an issue. Technology is one of the largest, it is the largest sector of the market at 20-some-odd%. So if technology is rolling over, probably not a good sign. If some of these major companies like Microsoft that are pulling the market higher begin to resolve their consolidations lower instead of to the upside, that's probably an issue. Right now we're okay, but we want to see Microsoft following Apple, following JP Morgan Chase, and making new highs very soon. Australian dollar is a risk-on currency. The yen is a safe haven asset, so if we see the Australian dollar underperforming the yen, that means that that risk appetite is low, that people are defensive. So we definitely want to see this moving higher. Right now it's moving lower. Not a great sign for equities in general, something we want to keep an eye on. Same thing for risk barometers here in the US. High beta stocks versus low volatility stocks. If you're bullish on equities, you're buying high beta names. You're not buying Procter & Gamble and some of these low vol names. So we want to see this ratio start to work its way higher. Finally, if we see staples and other defensive sectors break out on a relative basis, again, that is showing defensive leadership, that is showing people are, have reduced risk appetite for equities in general, probably not happening in an environment where equities are doing well as an asset class. Alrighty, so to conclude, so I can go off to the side and use my inhaler. We believe that we are in a cyclical bear market over the last 21, 22 months within a secular bull market. We think this trend ultimately resolves to the upside. As you can see, breadth in the US and globally especially, is improving. We're seeing new highs across the board. That is supportive of the bull case for equities. Rates are stabilizing, not only in the US, but all around the globe. That'll help financials, cyclicals, and the broader market because we need to see that rotation into financials for the next leg higher. Specifically international, if you look at Europe and the sector components there, they do not have as much exposure to technology in other areas. They're very bank heavy. So if banks start outperforming, you can start to look for potential outperformance from Europe as well. And then finally, a potential bottom in commodities would support emerging markets, would support cyclical stocks, which again is probably happening in an environment where risk appetite is rising and equities are doing well. So, thank you for having me. I really appreciate you listening to my spiel and looking at my charts. I hope you enjoy this as much as I did. Email info@allstarcharts.com with the secret passcode charts. I'll get you the slide deck. I know we skipped some things. Find me afterward if you have questions. Would love to chat about this. But otherwise, enjoy the rest of the conference. And thank you guys again for having me. Appreciate it.